crushed.
All right, another record high for the S&P 500 yesterday, 30 minutes away from the start of cash trading today. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, an exclusive interview with Cliff Asness, founder of quant asset manager AQR Capital. We'll get his take on markets, Trump, and artificial intelligence.
And Jaguar's radical rebranding. The iconic British car maker reveals a new vehicle design that's capturing a lot of attention. We'll talk to the head of the luxury automaker in the next hour.
And BlackRock expands even further in private credit, buying HPS Investment Partners for about $12 billion. The deal propels BlackRock into the highest ranks of one of the hottest trades on Wall Street. All of that and more coming up. Let's take a look at where markets are trading. Like Matt Miller said, we are 30 minutes away from the cash open. It's pretty quiet right now, pretty much unchanged on the S&P 500. Of course, it has been quite a climb year to date, quite a climb in the past couple weeks. Maybe taking a little bit of a breather right now. You take a look at the NASDAQ 100, a big day for big tech yesterday. Down a little bit this morning, cooling off by about 0.1%. And then you take a look at the bond market. A little bit of a bid has materialized this morning. Yields down about 2 basis points. We are below 420 on the 10-year Treasury yield.
All right, just under 420 there. My eyes are glued to the ETF Go function on my Bloomberg terminal because of the amazing amount of inflows we've seen into ETFs. In fact, we're just $9 billion away from $1 trillion of inflows into U.S. ETFs alone. So there is really extreme bullishness in this market.
But why buy the index when you can buy and sell single stocks? We're going to take a look at some moving right now. Zscaler's shares are falling. They have given a forecast that failed to excite investors, and the stock now down about 6.5% pre-market. Analysts also note that the company's billings growth was lighter than expected. We're also looking today at U.S. steel just plunging about 7.3% lower after Donald Trump says he opposes its sale to Nippon Steel, instead proposing to use tariffs and tax incentives to revive this American company. Also watching Tesla. A Delaware judge ruled that Tesla's board was improperly influenced by Elon Musk when adopting his pay package worth some $100 billion as of yesterday, voiding the deal. Tesla now down 1.5%, but remember, China deliveries also, Matt, came in lighter, and this spells a little bit of relief for Tesla that has been flying since the election.
All right, so much going on today, but really I think it's about peak bullishness. Yesterday we got a story out of Jane Street, which specializes in ETF market making, and they had more than doubled the amount of money they made in making markets in the third quarter over last year. Plus, ownership in U.S. equities across household financials and international is near a record high. Valuations are at a record high. So we continue to hit record after record. Citi said there's no more shorts.
I was going to point us that direction because that was a pretty interesting note. In addition to all the positioning, in addition to all the optimism, you take a look at the short sellers capitulating here. Citi saying that you take a look at investor positioning in S&P 500 futures right now, it is completely one-sided, whereas in Europe, investors have been net short for several weeks, and 100% of futures long positions are in a loss right now.
You know, it's interesting. Speaking of going long, I also thought it was really interesting to see NYU's Dean of Valuation, Aswat Damodaran, really talk about how even the Mag 7 has more room to run. He says those valuations are justified given the free cash flow. And, you know, our producer, Dan Curtis, also made that point that if you look at the Mag 7, 6 of them really do have the best free cash flow by a very large margin in the S&P 500.
Yeah, that was an absolutely fascinating conversation with Haslinda. I mean, I highly recommend people go on Bloomberg.com and check it out. Let's bring in Edward Jones, Senior Investment Strategist, Mona Mahajan, because, Mona, there's a lot of talk today really about the concentration risk in U.S. stocks and within U.S. stocks in the Mag 7. And sure, they're generating a ton of cash, but everybody's in this trade. Is it too crowded?
Yeah, you know, look, we are certainly still believers of this broadening of market leadership theme. So as we look back over the last couple of years, certainly in order to outperform in your portfolios, you needed to be concentrated. It was all about Mag 7, AI, really the the building blocks of AI that drove the market higher in 2023 and most of 2024. But when we think about the next kind of 12 to 18 months, what's a winning portfolio going to look like? We think it's a combination of, you have to have some of those tech building blocks, but you have to have some diversification in there as well. That includes not only large cap stocks, but mid cap stocks, and that also includes some value and cyclical sectors. We think where the scope for valuation expansion exists, that is really outside of tech largely and in the other parts of the market. So diversification will be a key theme going forward.
And Mona, I just want to talk a little bit more about those positioning metrics, because we debate all the time whether or not it's scary that this seems to be a fully allocated market. If you take a look at households, if you take a look at institutions, professional traders as well, you think about this rotation that you see coming. Do you think the positioning could be a stumbling block?
Yeah, look, certainly a lot of folks are invested in the equity market. Some of the broadening of market leadership could occur because they are rotating. So maybe they're selling some of their winners and repurchasing or thinking about adding some of those lagging parts of the market. But some of it could come from outsized positions in cash still. We've heard about the now $7 trillion sitting in money market funds. We know there's some reinvestment risk there. Although keep in mind, the Fed rate cutting cycle looks shallower than it maybe once did. But nonetheless, rates look like they're moving lower over the next 12 months. And so we may start to see a little bit of repositioning out of cash-like instruments back into the market. And we think when we go back into that market, we're going to see a broadening theme occur. So a combination of rotation and then adding cash to the market.
If you think rates are going lower, then how much do you really diversify into the bond market still? You look at the 10-year alone. Katie pointed out we're below 420, and we were very, very close to 450 just a couple of weeks ago. Do you think that there's a lot more room to run, and do you put significant dollars to it?
Yeah, it's a great call out. Look, the bond market, the nice thing is, balanced portfolios really have a more meaningful place for investors once again. So, when yields were at the zero bound for the Fed funds rate and Treasury yields were close to 1% to 2%, not so exciting of a return coming from the bond space. But now we do think Treasuries will hover in this 3.5% to 4.5% space, even as the Fed lowers rates. And that gives a meaningful return for not only savers, but also those with balanced portfolios. They say the best indicator of future return for an investment grade bond is where the yield begins, where you buy, what the yield is when you buy the bond. And if you think that yields are still at or near peak levels, this is still a very interesting time to maybe start thinking about extending duration on investment grade bonds. Certainly if you're closer to that retirement life, you will like to have some of this kind of a little bit higher returns and higher yields than you've seen any time in recent history. So balanced portfolios, we think, have a really nice place in portfolios. And we still think parts of the investment grade market, especially as you start to think about extending duration, makes a lot of sense here.
We are going to talk with Cliff Asness in about an hour's time. He and AQR have made a lot of money going into commodities, and it looks like not a lot of other people are involved. If you look at the Bloomberg Commodity Index, for example, it's lower than it was when the year started. Is this a good way, you think, to hedge the potential risk of a frothy stock market?
Yeah, certainly commodities are an interesting play on the global economy. And so if you think there is a nice rebound coming in the global economy because global central banks are lowering rates, maybe China stabilizing and rebounding, we think the commodity markets will benefit. But keep in mind, this has been an environment of U.S. exceptionalism. And so really the asset classes that have really worked well and we think may continue to work well are more domestically focused. And so those include, as we talked about, large and mid-cap stocks, but also parts of that value and cyclical market, value and cyclical S&P 500 sectors. They are more domestically oriented than, call it, your tech and AI sectors, and certainly more domestically oriented than those commodity markets. And so we think when you think about where really you want to be positioned, probably think about more of those domestically oriented asset classes broadly.
Interesting. And within those domestically oriented asset classes, within the equity market specifically, do small caps fit the bill here? That, of course, is one of the bullish narratives around the smaller companies, is that they tend to have less of that international exposure.
Yeah. Small caps certainly will benefit from that more domestically oriented exposure. Our view is small caps and mid caps, actually both percent of revenue that come from domestically are almost identical at close to 77%. Small caps, we still think, have a few headwinds in that they are more leveraged. And even if rates are coming down, they're not coming down all that much. And they tend to have less positive earners, so more of those quote unquote zombie companies. So, in our view, if you're going to kind of play that broadening theme across the market cap space, mid caps is a nice way to kind of capture that and have a little bit of positive earnings momentum as well.
Mona, we have to leave it there. That is Edward Jones, Senior Investment Strategist, Mona Mahajan. We're going to get a look at some stocks moving ahead of the opening bell. We're going to bring in Abigail Doolittle.
Well, beneath the surface, Sonali, we do have the shares of Zscaler falling by about 6.5%. There was a big beat for the cloud-based security systems company. However, valuation super rich, trading 70 times next year earnings. For the second quarter earnings guide, it was a little bit light. The billings growth also less than desired, so investors taking some chips off the table. One stock that is soaring, though, Credo Technology, the technology holding company, results much better than expected, up a whopping 36%. Some of this is a short squeeze, but there's roughly a less than 5% bearish short interest. So lots of actual buying here. Analysts talking about an AI-driven turning point. This stock into today up 146%. So one of those big AI names, or becoming one of the big AI names, perhaps. And then finally, let's take a look at the shares of AT&T, up about 3%. In an analyst meeting today, they did talk about guidance for 2025. It's a little bit better than what analysts are expecting. They're also saying that they expect profits to accelerate into 2027. They announced a $20 billion buyback. Investors liking this, Katie, with the shares of AT&T up about 3%.
All right, Abigail Doolittle, thank you for that roundup. And coming up, BlackRock making a big splash in the world of private credit. We'll take a look at their $12 billion deal for HPS next. This is Bloomberg.
Let's get now to high interest. Look at what's making headlines around the world. South Korea's president declared martial law in an emergency national address televised live minutes ago. President Yoon said the decision was made to protect freedom and constitutional order, and he accused the opposition of trying to paralyze the administration with impeachment moves. The opposition party, the South Korean won, tumbled to its weakest level in 2 years on the news. France faces a moment of truth. The government could collapse tomorrow as lawmakers vote on a motion of no confidence against the administration. The far right and the left-wing coalition are united in wanting to topple the current regime. Parties supporting the government don't have the numbers to prevent that from happening. And Bloomberg has learned that SpaceX is in discussions to sell insider shares at a valuation of about $350 billion. That's a significant premium to the $255 billion valuation reported last month. It would also cement the status of Elon Musk's rocket and satellite company as the most valuable private firm in the United States, in the world.
Incredible how those private markets are booming. Those private markets also converging with the public markets. And there's one firm that's keeping a close eye on it. One stock we're watching this morning, BlackRock. The Wall Street titan set to buy private credit firm HPS in an all-stock deal for about $12 billion, and it propels the world's largest asset manager into the highest ranks of private credit. Let's take a closer look here with Bloomberg's Sridhar Natarajan, and let's just say a lot of hearts were broken in this transaction. You had HPS that we had initially reported tried to go public, now selling to BlackRock instead. You have a co-founder telling analysts this morning on the call that the reason was to really change the face of capital markets moving forward. How is this team set to do that, if they can at all?
So let's go back and look at the firm that they're joining, BlackRock, one of the largest asset managers in the world, $11.5 trillion. But when it comes to private assets, especially in private credit, maybe irrelevant is too strong a word, but BlackRock was certainly punching below its weight. Now, with this deal, it is an important step both for HPS because it gets the BlackRock platform, but even more important for BlackRock because in the asset management industry, the biggest growth has been coming from the alternatives bucket. And within that bucket, private credit seems to be the most attractive pocket, at least judging by the money flowing into it. Even BlackRock strategists have predicted that this market that's already ballooned to about $1.7, $1.8 trillion could double by 2028. And that's a big step forward. BlackRock did not have scale there. It was going to be hard for them to do anything in an organic fashion. So this makes sense. They had to make a splash like this, and they've done that here.
So where does this leave BlackRock in terms of the league tables? Because so far the narrative has been BlackRock is racing to catch up. That's why it's making all of these acquisitions. But with HPS now, the alternatives business will actually be bigger than Carlyle. So how should we be talking about them when it comes to the industry?
And it's important that you talk about all the deals that they've done because it's not just HPS. If you look at what BlackRock has accomplished in the last 12 months, two of the biggest deals in the asset management industry, HPS comes with about $150 billion in private credit assets, but also GIP, which has $170 billion in infrastructure assets. Take that together, and BlackRock's private market assets have more than doubled just with these two deals in the last year. They also had the deal for Preqin, the data provider. So clearly they're making a big push. And I'd go as far as to say, back in 2009, the deal that BlackRock struck with Barclays to buy the index fund business and how that transformed BlackRock, this could have a similar transformational effect if executed well.
Transform them in terms of putting them as one of now the biggest issuer of ETFs, which also transformed the whole landscape.
Is there any concern, is there any regulatory concern here, especially considering the Texas lawsuit? I mean, even if it's only a passive custodian of, $12 trillion in assets, it still can obviously exert some kind of influence.
Look, we are heading into 2025 and a new administration, and who knows what policies they will bring with them. It will be unpredictable, and BlackRock certainly has been a lightning rod, at least for a lot of the big conservative players, especially with their push in the index business, with their passive ownership and the influence they were exerting. But this is in private markets. We haven't gotten the sense that this is going to face any real regulatory trouble, but it's hard to rule it out at this stage.
One interesting part of this, too, is BlackRock already has an insurance business that serves about $700 billion worth of assets for insurance clients. This helps bring them closer, but it's not the Apollo model where they bought an insurance company. One thing, though, to consider, I think, is when you say $4.5 trillion in private credit, you're talking about direct lending. How much can they broaden away from direct lending into other forms of private credit? Do we know about their desire to do that?
I mean, every pocket within private credit, however you want to slice and dice, is not just direct lending, is sort of what we're talking about in that $3.5 trillion bucket by 2028. So BlackRock would want to have a footprint in all of those pockets, and I think this deal will help them get there.
And let's just reflect on how many deals BlackRock has done to grown in this space. I mean, we're talking about HPS. You mentioned Preqin. You mentioned some of the other deals that they've done, GIP, for example. When does culture start to be a concern? Because that is just a lot of people, employees that you're trying to integrate into the machine that is BlackRock.
When does culture start becoming a concern? Yesterday. When you're talking about two big deals, two roughly $12.5 billion, so about $25 billion worth of deals coming into BlackRock, it changes the face of their private markets investing business at a place which is a big force in public markets. But you also know, when you think about the private market investors, how they perceive themselves relative to public market investors is very different. They see themselves in a little more of an elite scale. So coming into a place like BlackRock, yes, they will operate with a little bit of independence and will be siloed off a little bit, but the gestation period is going to be fascinating to watch.
And speaking of culture, you have the founders of HPS joining the Global Executive Committee at BlackRock. So everyone's going to have a few new bosses. All
right, Sridhar, great to speak with you. Appreciate your reporting. That is Bloomberg's Sridhar Natarajan. Now, coming up next hour, more on the investing outlook with Cliff Asness of AQR Capital. This is Bloomberg. All right, welcome back to Open Interest. You take a look at stocks with less than 4 minutes to go, or rather 5 minutes until those opening bells. We're looking at a down day on Wall Street. The S&P 500 down by about 0.1%. Of course, we're coming off of some pretty big gains. We had another record close yesterday, so a little bit of a pause may be expected here. The Nasdaq 100, it's a similar story. Your big tech index down about 0.2%. And then you take a look at small caps, of course. Small caps falling a little bit yesterday. The Russell 2000 currently down about 0.2%. And it's very much December 3rd. And I am looking forward to the holidays. But there are some catalysts.
We just had the holidays.
You've got some weeks left.
I'm over holidays.
We've got 3 weeks until the big ones. But there's some catalysts. We have the jobs report, we have CPI, and we have the Fed. So we'll see what actually breaks this market out. But I don't know. I have to imagine that some people, after 28% year-to-date gains, are happy just to coast it in here.
Yeah, take some of those gains, call it a day. I also love a good day of diversification. This whole 10-year under 420 is pretty stunning given where we were just a few weeks ago, and it's all heading into that jobs number, isn't it?
Mm-hmm.
I'm just saying about taxes. As we get to the end of the year, you know, I pay so much for...
I'm thinking about the holidays. You're thinking about taxes.
Comparatively little in services. And we're going to talk to Cliff Asness. I'm super pumped to talk to him about the potential of limiting my tax exposure.
He's all about that.
Yeah.
Not just taxes, their value-focused funds have been outperforming the traditional value funds you've seen out there. So I want to know what he's doing differently than everybody else.
All right, a lot to look forward to here. And coming up, now less than 4 minutes until the opening bell, we'll discuss the market moves with Nancy Tengler. Really looking forward to that conversation. Don't go anywhere. This is Bloomberg.
We hit a new all-time record yesterday on the S&P 500. Doesn't look like we're set to hit it again today at the opening bell, which is just in 15 seconds. You can see S&P futures are down just about 0.07 of 1%. NASDAQ futures are down 2. Russell futures are off. So maybe a little bit of a softer open, but you never know what could happen during the course of the day. There's a ton of bullishness out there. And NYU's Rawdon said you should invest in a dip in Mag 7 stocks because they are cash machines. Not all of them, maybe not Tesla, but most of them are generating an absolute ton of cash. New York Stock Exchange opening bell. You see Vale ringing the bell down there. We're going to talk a little bit about commodities today. At the NASDAQ, you see Patrick ringing the opening bell. That's great of him to do. Now, let's get a check on the major averages. Katie, like I said, a little bit soft now, but just wait. We could rev up to another record.
That's true. Anything can happen between 9:30 and 4 p.m. We've seen that time and time again, and maybe that'll happen today, and it might be welcome because right now it's a little bit of a snooze. You take a look at the S&P 500. I'm going to go ahead and call that unchanged, maybe a touch lower if you're a pessimist. Of course, the S&P 500 is up 28% on a total return basis year to date, so the bull's taking a little bit of a break right now. Similar story if you take a look at the Nasdaq 100. Your big tech names, they had quite a moment yesterday, now down a little bit in these first seconds of trading, about 0.4%. And the small cap index, the Russell 2000, fighting to go green, pretty much unchanged. We'll see what happens with the little guys, but let's take a look under the hood right now because we're keeping an eye on Zscaler. Shares there falling after giving a forecast that failed to excite investors. Analysts also noting that the company's billings growth was lighter than expected. You add it all together, shares down about 4%, Sonali.
Yeah, I'm looking over here at another company. I'm looking at U.S. Steel down 7.5% at the open. It's just plunging after Trump says he opposes its sale to Nippon Steel, instead proposing to use tariffs and tax incentives to revive the American company. Of course, this has been a very fraught deal throughout, but of course, from the president-elect, seeing more negativity around the deal is not a fun story for investors, Matt.
Yeah, I mean, Trump has said that before, so it's not like unexpected. Although, to Katie's point, obviously people are selling the shares this morning, so maybe they didn't know. Or maybe they're just piling on. We're watching Tesla after a Delaware judge ruled that Tesla's board was improperly influenced by Elon Musk. I mean, obviously, when adopting his pay package worth some $100 billion as of yesterday, voiding the deal once again. Meanwhile, China ratcheting up trade tensions with the U.S., announcing a ban on several materials used for making high-tech chips. Bloomberg's Abigail Doolittle has the details. Abigail?
The trade tensions between the U.S. and China, Matt, really ratcheting up. And this is ahead of the incoming administration. It has to do with the Biden administration. Of course, President Biden's government has been escalating technology curbs, particularly around semiconductors. So China, as you've mentioned, they are banning exports on particular metals, particularly hard metals that are used in many technology and military applications. Now, this ban could cost $3.4 billion to the U.S., according to the U.S. Geological Survey. Let's take a look at some of the stocks that are somewhat related, because these materials, germanium and gallium, they're not common day metals that we talk about, but some of the hard metals companies, you could see mixed action there. Micron, this was one chip maker because China started some of this action back in July of 2023, and Micron was thought to be one of the chip companies that could really be affected. Higher today, Lockheed Martin, one of those big defense contractors that does not buy these metals directly, but it's thought that some of the metals could go into their applications, down slightly. And then finally, one barometer of trade tensions between the U.S. and China, or really a protectionist stance on the U.S. And this has more to do with the incoming administration, the future Trump administration, than the current administration. But you can see the Bloomberg Dollar Index since late September, when lots of the numbers started to support President-elect Trump, up about 5%, Katie.
All right, Abigail Doolittle, really appreciate that. And let's broaden out this conversation now, because joining us at the table, I am thrilled to say we have Laffer Tengler CEO and CIO, Nancy Tengler. Nancy, it's great to see you.
Thanks for having me, guys.
So I actually want to start with Intel. I was off yesterday, so I didn't get to talk about Pat Gelsinger's encouraged retirement, maybe a little bit. I'm sure you did.
He retired.
He retired.
Instantly.
Maybe, the board pushed him there. But in any case, I thought it was really interesting that even though we saw this initial pop, the stock still closed down about 0.5% yesterday. As someone who invests in Intel, what did you make of yesterday's news and the path forward from here?
Yeah, I don't think there is much of a path forward, Katie. We sold the stock a number of years ago. It was clear it was exciting when Pat came in, and then it was clear that he just wasn't getting the job done. He was spending his time going hat in hand to Washington, D.C. They were way behind on innovation, not his fault. That was Bob Swan. I think the board was negligent in making moves quickly to accelerate innovation. But one of the analogies for me is Xerox, who invented the mouse and invented a lot of innovation in technology, but didn't commercialize it. Who commercialized it? Microsoft and Apple. So you've got a company that's so far behind in a very fast-moving segment. And then as the day wore on, what you heard was, the foundry business is losing money, but the money they got from Washington was contingent on having a foundry business. So can they get rid of it? I don't know. And I think it's really going to take time to turn around this Queen Mary.
As a holder, then, what do you do moving forward?
She sold.
Oh, you sold it
years ago. Yeah.
Well, so then, what would change the story if this is a great American icon? Does a new CEO fix the problems that seem to have lasted far beyond Gelsinger?
Yeah, I don't know that it's possible. I mean, eventually you'll get a pop in the stock, but just think about Xerox. They were a verb, an industry leader, something that was impervious to competition. And in the old days, we used to joke that AMD was just kept around so that Intel wouldn't be a monopoly, and yet here we are. So when you have that many missteps for so long in technology, I think in a bull market, which I believe we're in, there are just much better places to be.
Well, you said it concerned you when he went hat in hand to Washington, asking for government subsidies. And I wonder if you can extrapolate that to other companies that do the same. Do you want to invest in a company like a Boeing, like a U.S. Steel, that has to ask Uncle Sam for money, that needs subsidies, that needs tariffs, that needs government support? At that point, don't you realize the innovation is gone?
Right. And I think that is the case. And then remember, they slashed the dividend. So, you're not even getting paid to wait, which is always I'm getting, 5% yield as a value investor. So they lost the value investing constituent. So, yes, I think you're absolutely right. And I think what we know about government is they're not very good at picking winners. And so while national security chip foundries on U.S. soil is important. You know, I live in Arizona where TSMC is building 2 plants, and I think that is a better way to solve it, where you have the technological leaders.
But we have the same problem with steel, right? We need that for national security.
Absolutely.
Airplanes,
Boeing.
we need to build those for national security. But none of them seem to be stocks I would want to invest in.
Right, because the leadership has been asleep at the wheel. And so you want a company that pivots. So our investing theme has been old economy companies that pivot to new technologies. One of those, a poster child, is Walmart. Compare Walmart to Kohl's. Compare Walmart to Target. If you pivot and you get ahead of the technology, or at least ride along with it, then that's something. I mean, there's no more old economy company than Walmart. So I think that's
General store.
Yeah,
that's true. I'm still stuck on what you said, that, you know, this, you think about what Pat Gelsinger did, and he went hat in hand to Washington. He actually did get money. You think about the CHIPS Act, that was quite a lot of money funneled at Intel, but management matters here, and it's striking. You think over the past several months, so many CEOs have been taken out of their jobs.
Yes.
Stellantis, for example, just a couple days ago, and there's plenty others. Even though we're in a bull market, even though it seems like this economy is humming along, you are seeing that turnover in the C-suite. And I wonder what that says to you about where we are in various cycles.
I mean, I think it's a good thing, Katie. I think that what we're seeing is boards that are finally engaging and not letting things go as long as they had in the past. So while it's a little unsettling if you're the CEO, it's probably a good thing to cut the losses, align incentives, align strategic direction. That is what a board is actually supposed to do, instead of just rubber stamping everything. So I'm actually encouraged by it, but I will say it matters what you own in this environment. It's not all industrials or all technology. The companies matter.
It was interesting to hear you bring up Walmart as well, because my question is, do you need to keep buying into the giants in the room in an era where we've seen the big get bigger? You think of even what we were talking about a little earlier, NYU's Aswat Damodaran talking about the Mag 7 having much more room to run given where they stand with free cash flow. What does that mean for everybody else?
Yeah, well, Sonali, I think what we know is that even though the economy is still in really good shape, it has slowed. I mean, real GDP is 2.8%, but inflation's been coming down. So nominal GDP has slowed pretty dramatically. So in that environment, I want to own the reliable earners and the great balance sheets. And so will we see a turn? I think so. If we get corporate tax cuts, what we saw last time was, you know, earnings and margins improved and corporate tax receipts doubled from the TCJA to last year. So I think you want to own, however, the companies that dominate. It's one of our themes as when we do the research, quality of management and what's the franchise value and market leadership. Third, what's the catalyst? And so, you know, there's been a number of stories written about Alphabet's demise in search, and then the flip side of that is no, in fact, they're going to turn AI around and I don't know what the word is, compete with themselves. And so I think, you know, we have to remember these companies have all the money in the world to solve the problem. And so Intel's balance sheet had, deteriorated. These other companies, I mean, I'm not a huge advocate for all Mag 7 because some of the valuations are, a little heady. But
we've been thinking about, there's one Mag 7 company that,
that I own,
Tesla?
They make electric cars and it's not a ton of cash flow, right? We were looking at the balance sheet
have
this
they
morning.
just flown higher because of the Trump effect? Do you think that it's a little... So what do you do with that?
You trim it, and then you make a decision about whether or not, which is what we've been doing, whether or not, I mean, I don't think of it as an EV company. I think of it as a technological AI company. And one of the things I think we've talked about in the past is the Megapack business, which grew 52% last year. That's electric utility grade batteries. That's a pretty impressive growth rate. Small business, so law of small numbers. But I think you have to think about this company as an innovator. And I mean, he's doing it across the board.
And you've made a ton of money on it. And as Damodaran said in his interview with Hassan Amin, this is a pricing market thing, right? This is a momentum. This is a feels story and not really like an earnings story, but a vibe story for sure.
Well,
Nancy, I love having you come in here because we get to understand the way you think and then see how you apply it in your portfolio. So we're really lucky to have you. Thanks so much for joining us. Nancy Tengler, CEO of and CIO of Laffer Tengler. Coming up, with equity optimism and valuations so high, this could turn out to be potentially one of the worst times to go long. I mean, we have to give you these warnings when we're at these heights. We'll talk about it next with Simon White. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Deutsche Bank upgrading CVS Health to a buy. The analyst cites the recent leadership changes, as we were just talking about, and notes that the earnings recovery for its managed care operations seems achievable. Next up, Jefferies upgrading Kroger to a buy, noting that the company has upside potential whether or not that acquisition of Albertson actually goes through. The analyst also says that foot traffic has been improving. And finally, we have FedEx no longer a buy, according to Bernstein. The firm anticipates that the package carrier will lower its full-year outlook when it reports results later this month. And the analyst also anticipates higher tariffs under the Trump administration that could hurt air freight volumes, Matt.
All right, interesting stuff there. Let's talk about the ones you know. The Magnificent Seven stocks are a buy during corrections, as most of them will keep generating a ton of cash, according to New York University professor Aswath Damodaran, who is known for his expertise on valuations. Listen to what he had to say.
I've never seen a group of companies carry a market for as long a period as the Mag 7. These companies are special companies. They've been able to scale up not just revenues and growth, but some of them are insanely profitable. As a value investor, I've never seen cash machines as lucrative as these companies are.
Bloomberg's Simon White joins us now. His Macroscope column argues that this may be one of the worst times to invest for the longer term. And Simon, I thought of you as soon as I heard Damodaran's talking about the Mag 7. Now, you're talking, I guess, about the broader U.S. stock market, right? But what do you think about his take on these companies that are generating, 75% operating margins? It's just massive.
Well, yeah, I mean, there's a lot riding on the Mag 7. They are part of the kind of the US exceptionalism that I was kind of wanting to get to. I mean, you take out these companies, the US market doesn't look quite so exceptional. They are like principal drivers. But there's a lot riding on what people are expecting from them, right? This AI productivity revolution that people are expecting, it may happen, but I mean, there's a lot riding on the current iteration of AI, the large language models, huge amount of investment. Your previous guest was talking about the capex and stuff that these companies have and the cash that they have. They're spending a massive amount of money on data centers, but there's a lot riding on this. What's priced in really coming to fruition. I mean, you can look at NVIDIA, it's at 20 times sales.
Simon, you made another great point here that it's not just the Mag 7, it's not just those AI high flyers, but it's also international stocks trading as ADRs. The premium is pretty significant when you look at, for example, TSMC, which of course is riding the AI wave as well. But where else are you seeing this exuberance when it comes to that US exceptionalism?
So you're seeing it obviously in things like that. I mean, a $200 billion premium for a company that, maybe 20 years ago you could argue that there should be that premium because it was harder for foreign investors to invest in Taiwan. But really the only real main reason I can see now is this people just want to be in the US. So there's this kind of zeal for US stocks. And I also think people are looking at there's a sort of lack of high quality global alternatives to US stocks. But, as usual in markets, you get this kind of herd mentality. So you're getting these kind of like, which look like very bizarre mispricing, such as the ADR. You're seeing a huge amount of leverage. So if you look at the rise in leverage ETFs, I mean, it's at hundreds of billions of dollars now. I mean, that's mushroomed in recent years. People, it's not just enough to get like 1 times return. I mean, 185% on NVIDIA, you can get a 2 times ETF. So you can double that, right? So you're seeing a lot of extra risk come into the market that it may keep going for now, but it's hard to fashion an argument ex ante that says that this is going to be a very good longer term time for investment returns.
And you talk about that valuation premium. I think it's interesting. I mean, you're seeing it across the globe. It's why European countries are choosing to switch their listings to the U.S. because they do get that bump up in valuations. But Simon, we don't have a lot of time left. I do want to talk about U.S. exceptionalism a little bit more. I was playing with some charts this morning. Over a year period, year to date, the S&P 500 is up 28%. The MSCI World ex-US Index is up 8%. You zoom it out to 10 years, those returns go to 250% for the S&P 500, 82% for the rest of the world. So the U.S. tends to outperform. What could happen in the next decade that would make things actually be different this time?
So there's a lot riding on this. I mean, obviously everybody is coming into the US, it's pushing valuations so high. So not only do we have a very over-owned market, so we have across all the cross-sector, so whether it's the household sector, the corporate sector, financial sector, they're all almost all-time highs in terms of equity ownership, and the rest of the world too. And they're pushing valuations up. Now, normally what happens is when when ownership is very high, it's because valuations are quite low. So people are expecting to see higher prices because basically valuations are low. But we've never been in a situation where we have ownership so high and valuation so high. And that's why it's just extremely difficult to see a situation where on a longer term basis, we can have the returns that people are expecting. So as you say, 25% or 28% year to date, 25% last year. I mean, to sustain that over the longer term, it seems like an impossibly high bar to cross.
Simon, we thank you so very much for your time. And of course, you must read Simon's column on the Bloomberg Terminal. That is Bloomberg Simon White. Now, coming up, Jane Street has had a record run this year. We're going to take a look at what's driving the strength behind the market maker next. This is Bloomberg. Time now for the Wall Street Beat, and today we're looking at a Wall Street fascination. That is Jane Street posting over $14 billion in trading revenue through the first 3 quarters of this year. That is already putting it on track for a record year. Joining us now with more, Bloomberg's Catherine Doherty, who co-wrote the story, broke the story, has covered Jane Street here for a while. You know, they have been considered, as you've talked about before, Matt, an ETF giant, but they have been expanding.
That's right.
And so how has that expansion helped them get to this point?
So they've gone into other asset classes beyond ETFs. They used that expertise and went into credit. So they've now are one of the more dominant market makers within not just portfolio trading in the bond and corporate bond space, but they're actually doing the individual bonds too. And you've seen Citadel Securities, one of its competitors, they've now entered the corporate bond market, but Jane Street was the first to do that, and they're now an established player in that space.
Well, I'm glad you brought up Citadel because, of course, you have Citadel Securities and then you have Jane Street as these rivals. Citadel has a very public face, which is Ken Griffin, but talk to us about the structure of Jane Street because they don't have one singular CEO.
So they have a partnership, and each of these partners, they like to think of themselves as a very even, they have ownership, but beyond the equity ownership, they like to have it be a little bit more open, and that way that you can rise through the ranks, and there really aren't structured ranks per se. So it makes it so that you don't have a very public face. Peng is Citadel's CEO, and you're right, he is one of the more public now faces of the firm. Jane Street has always been more quiet, and in fact, they really didn't start getting into the headlines until FTX, Sam.
I was going to say, I think of Sam Bankman-Fried when I think of Jane Street.
But that is not their claim to fame per se. Many people do think of them because of Sam's tie to the firm, but they've been more dominant beyond.
Yeah, they're absolutely crushing it. Great story. Catherine and I read it yesterday and was pretty excited about it. Talking about it today. Catherine Doherty there on Jane Street. Coming up, we're going to talk with Cliff Asness from AQR, a conversation you do not want to miss. it's supposed to. We're 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We're awaiting some economic data as it pertains to the labor market. Let's take a look at markets as we count down to that JOLTS release. The S&P 500, if we showed it, there we go. It's pretty much unchanged, of course. You take a look at the NASDAQ 100, pairing its losses, and we do have that JOLTS release. So let's get right now to Mike McKee. Of course, he is our economics and policy correspondent. Mike, what did we learn?
We've learned that we have another surprise. A lot more job openings than we anticipated. 7,744,000 for the month of October. That is higher than the 7,372,000 that we found for the month of September. It's also significantly higher by about 200,000 than the anticipated forecast, the consensus forecast. So the question becomes, how does this affect the economy? We're still looking at the sort of quit rate, which is up now to 2.1%. More people leaving their jobs during the month of October, feeling a little bit better about the overall job situation. So at this point, looks pretty good, except for this, and that is that yesterday, Raphael Bostic, the Atlanta Fed president, brought up the idea that these numbers may be distorted because there may be a lot of phantom jobs in these job announcements. The companies are not hiring as they were. We'll see, of course, on Friday whether that changed, but companies not hiring as they were, so a lot of these may be just leftovers or just extra jobs, and they don't really mean that there are that many job openings out there. The Fed is looking into that.
Michael McKee, we thank you so very much for your time and analysis. Quick check on that S&P 500. As Katie had said, it is turning around. It is roughly now unchanged on the day. And of course, we are coming off those record highs. Like Matt said, everything can turn around in just a couple of hours. And joining us now for an exclusive conversation about these markets, Cliff Asness, AQR Capital Management founder, managing principal, and chief investment officer. We've been talking so much about these record highs we've been experiencing, but within those record highs, there's a tremendous amount of stock market concentration here.
Sure.
There's few stocks that have benefited so disproportionately. How do you invest through that?
Well, first, it's a lot easier to be a quant at these times. We do run some traditional portfolios, but a lot of what we do are long and short, and it's very common for us to be long about 750 stocks around the world and short about 750, balanced by industry. So we do the courageous thing and run away from this problem. We've had very good years with the Mag 7 soaring, even though value strategies are part of what we're doing. The opposite hadn't happened in a while. The opposite could happen. So concentration is a problem for a typical active manager and for us in some places when you're only allowed to go long against a benchmark. Because a lot of your information, if you're a good active manager, is about what not to own. And when some things are so concentrated and big, it shrinks the size of everything else and makes that information less relevant. When you're long short or even a traditional portfolio that allows you to do a little bit of shorting, that really goes away, and you don't have to think a lot about the Mag 7. You just have to think about what you like and don't like. So I mainly run away from this problem.
You know, speaking of running away from the problem, you have one fund in particular we're taking a look at. My colleague Justina Lee pointed this out. You have an equity market neutral fund that is up about 23% this year. You're beating the market on that
I'll take your word for it.
And that fund, I'm interested in it because traditional value factors, generic ones out there in the market, have not performed that well. What do you do differently with value?
Yeah. I have literally a piece on our website saying we are not all about value, except occasionally when we are. When the world goes into absolute bubble mode, anyone who cares about price is affected by it. But value is only a component of what we do. Some particularly strong things over the last few years have been, and this year, have been quality strategies, profitable companies that are stable, low volatility, low beta. Some of the more proprietary things that people at my firm will kill me if I try to talk to you about, but more ML and alternative data kind of things. We have had, you quoted it, they get mad at me if I quote it, but we've had a very strong year. Our versions of value, when you go global and you don't take big industry bets, probably about flat on the year. It's not been a terrible year. You get very distorted. The value indices are cap weighted, and we all focus on the US. So they really are Mag 7 against everything else. Mm-hmm. Real world particularly quants, but even non-quants, are often much more subtle in what they're doing. So not a terrible year for value as we define it, but that's not been the driver. It's been the other stuff that's made it kind of fun this year.
And
so I don't want to, still
go on.
a bunch
We have
of
time.
I just mean the year is not over. I hate year to date until December 31st. 4 o'clock.
You really want the fat lady to say.
I do. Yeah. I'm a superstitious quant.
Okay, there you go. I will say you can say anything on TV One, so feel free to talk about your returns, single stocks, and I do want to get your thoughts on size, because a phenomenon that we've been discussing is the fact that you don't have a lot of small cap IPOs anymore, that companies are waiting in the private markets until they're a little bit bigger, so maybe they bypass the small and the mid cap index, and that's spurred the idea that maybe the small cap premium has disappeared as a factor. I would love to hear your thoughts.
Yeah, well, this one again, I'm gonna turn the question around on you like a quant.
Okay.
We don't think there's ever been a small cap premium.
What does that mean?
Well, certainly sometimes small caps win, but a premium means they win on average. That on average you make extra money. The early tests of this were in the early 1980s when the so-called small firm effect was discovered. I arrived at the University of Chicago about 5 years after this but it was there, it was being done. And it showed that after adjusting for their beta, another thing quants do, and non-quants, if you're making extra money just because you're a 1.5 beta and markets go up, you'll make more money than a 1 beta. And small cap does tend to be more sensitive to the market. The early tests had to estimate delisting returns. The databases just say delisted, so you have to guess at how much you would have recovered from that. And they overestimated how much you recover. And they didn't adjust enough for the fact that the traditional statistical methods, I love statistics, but they grossly underestimate the market sensitivities, the betas, the volatilities of things that don't trade every day. And a lot of small caps don't trade enough. When you adjust for both those things, there's not been historical small premium. Now, today, it's interesting. I do think this effect of companies waiting longer, it's probably more, we don't trade on this, it's just an opinion, but the small world is probably a more distressed value world even than it normally is. So I don't think that necessarily means, if you believe in the premium, I don't think it necessarily means it's gone. It could just be suffering along with value strategies in general. I know a fair amount of people who look at this think the spread between cheap and expensive in small is even wider than it is in large cap, where it is wide versus history. So it could be a sea change, or it could just be bad things that have happened that lead to good things.
I have a sea change question.
Please.
So I pay like half of my income to the U.S. government in taxes. Here in the capitalist, free market.
Cliff wants to help you.
Matt talks about taxes.
City of New York.
No,
But I lived for like 10 years in Germany, right? Socialist Germany, where I paid less in taxes than I do here, and I got free healthcare and childcare there. Yeah. So when I see a story about reducing my tax liability, I'm reading it. Justina Lee wrote a great story about you guys. Quant giant AQR cuts income tax bills for wealthy clients.
Yeah, I hated the title, but okay.
Well, how can I get in on this? Like, what am I missing that I'm, losing half of the money I earn and not getting anything back for it?
Well, getting even bigger picture, the difference between Germany and the U.S., you raise a fair general point. People don't realize that at least when it comes to income tax, the U.S. tax code is far more progressive than a lot of other countries that are thought of as more progressive. So you're not imagining it. You are paying a very high rate. For us, it probably started about 10 years ago. We always co-invested with our clients, who are almost all non-taxable institutions, pension funds, endowments, foundations, sovereign wealth funds. And we knew this was kind of stupid in some ways. We believe in our strategies, but you shouldn't invest the same for a taxable investor as a non-taxable investor. It always shocks me when people are like, you do that for them? I'm like, yeah, you remember we're fiduciaries. Yeah. We have to do what's best for the client. And classic example is, if there's a stock you loved a year ago, you made a lot of money on, it's 11 and a half months later, and your model or your process or even your active managers, if you're not a quant, wants to sell it. If you're a tax-free institution, you just sell it. If you're an individual, you're crazy not to wait 2 weeks. right? I don't know anything about the next 2 weeks. I wish I did. I'd be Jane Street. You just talked about them if I knew about the next 2 weeks. So you wait 2 weeks, and they design some silly things in the tax code, like the difference between selling something after 364 days at a gain and 366 days is dramatically different in your tax bill. So we don't do a darn thing different in terms of gross alpha. We are basically, well, you have to do, except for holding it another 2 weeks or something, we are still running mostly about making money before taxes.
Right.
We're running our standard process. But the major things which turn out to matter a lot if you do them systematically are if we're running your money after tax, and you're an institution, and we're running your money pre-tax, and we decide we hate a stock we used to love, we'll sell it for you and we'll wait 15 days to sell it for you. That doesn't sound so powerful, but when you're long short and you have 750 longs and 750 shorts, and when you're us, which we got kind of lucky on this, our average holding period is just under a year anyway.
Right.
So we are making a ton of decisions naturally, part of the pre-tax alpha process around that key decision point. If you're a high-frequency trader, you can't do very much. You're realizing it all every day.
Right.
If you're Warren Buffett, you already have a good tax plan. Mm-hmm. It's eventually to, hopefully not for a long time, but to die and to pass it on to your heirs or charity tax-free. 1 year is a beautiful time because the tax code is kind of silly about it. Mm-hmm. The tax code I would write is not necessarily the tax code that I will, as a fiduciary, manage my clients to.
Well, I want to talk about the after-tax return a little bit more because, of course, there's always been a focus on after-tax returns, but it feels like there's more and more products that are coming to market that are focused on the after-tax return. I think about, what's going on in the ETF space where I live, and there's an attempt here to make exchange funds in the ETF wrapper. And to get a little dystopian, I wonder if that's like the future of asset management, after-tax return products and leveraged single stock ETFs.
Yeah. I mean, I have strong opinions on what's the best way to do this. Exchange funds, I watched some of them at Goldman Sachs 30 years ago. They always struck me.
Yeah.
We like to do really natural things, like we're doing our process anyway, but we're going to wait 2.5 weeks to do this. Those always struck me as a little...
It's like alchemy, kind of.
Yeah, I'm not super comfortable with that kind of solution. But what you said in general, a larger focus on after-tax, I have been waiting for this for my entire career. As a little kid in this business, this is not genius. I think a lot of people did it. I was like, why do taxable people focus on pre-tax returns? I mean, there have been studies that look at mutual funds and say the money flows to the largest pre-tax return, which is often, for the obvious canonical investor, not the best post-tax return. Rob Arnott, who's been a friend of mine for a long time. We've written articles back and forth.
Very aware of that.
But he wrote a brilliant piece on this, I think in the 80s it might be, saying, but nobody cared for a long, long time. So I think it's a positive development. I think you have to have pre-tax alpha. You can't do things that are just about taxes. But once you're doing it, you should run money different for your taxable investors. And that is shockingly new. It should have been a long time ago.
Let's switch back to something you were talking about a little earlier. We were talking about places. Let's talk about it in terms of places to find alpha because you had went there. Where outside of the stock market are you finding it? You've made a lot of money in recent years on commodities. A lot of people have been talking about bonds. You're weeks away from putting around new capital markets assumptions. How do you think about diversification? What's the new 60-40?
The new 60-40 is still 60-40. I don't know who on earth has ever invested at 60-40. Somehow that became, you have to do 60-40. If you write a piece like we do on the prospective returns of 50-50, the world goes, I can't deal with this. This is 50-50. We do think both stocks and bonds, and this will be reflected in our piece that's coming out soon. We do these capital market assumption pieces. They're really a client service. We're interested. We don't trade on them. They're like 10-year signals. I've had a couple bad years in a row that I can survive. Things that only work over 10-year horizons are not very practical. Mm-hmm. And they often give you kind of weird indicators. They'll say things like, we expect to make less on the next 10 years on 60-40, particularly on stocks, than the long-term average because they're expensive. You know how hard it is to make money with the phrase make less? What if you underweight or short them? If they go up but less than normal, at the end of 10 years, you tell your client, we lost you money, but we lost you less than we would have in the 20th century.
We talk about this a lot. Yeah.
And people don't get very excited about that. Having said that, everyone's got to plan their life, from individuals to pension funds. How much am I going to make on my assets to cover what I have to cover? So these numbers are very important. If you're going to make less, it's important. But I want to be clear, it's not a trading signal. But because we think less of the markets, we think diversification away from 60-40, which, to be honest, we always believe in. So I'm singing a song I would sing all the time. But we do think it is somewhat more important when markets are probably offering you less. Trend-following strategies, long-short equity strategies that are truly short, not long-short, because that's just, window dressing.
Right. What's the best advice you would give to somebody who's primarily an equity investor? It's kind of like what David Kostin was saying a couple weeks ago at Goldman Sachs. If you're standing at these valuations and you're worried about long-term returns and you're investing today, how do you play just equities?
If you're playing just equities, but it's in your question, you are stuck with just equities, then it's about, can you add alpha to it? And we think some of the more publicly known things, buying high-quality companies at reasonable price, what Warren Buffett does, we think is still going to work going forward. It doesn't fix the equity risk premium. To fix that, you have to go outside of equities or be willing to short some equities. So within equities, we still think there's alpha for active managers who have a disciplined, rational process. But to cheat the question, I think to really move the dial on an all-equity exposure, why are you all equities? You've lived through one of several, but a golden age for equities. And people tend to look at 10 years and extrapolate that forever, when in real life, at that horizon, there's at least some degree, again, it's not a daily tradable strategy, but there are at least some degree of mean reversion. So the world on average gets this a little backwards. They get all excited and are comfortable with 100%, whatever it is, 100% one thing, when that one thing has won. Same thing for US versus non-US. US has crushed the world. Most of that has been the US getting more expensive than the world. The fundamentals have come in somewhat better on the US, but as we measure, that's about 10-15% of the US's victory. 85% is people being willing to pay more for those multiples.
Yes.
That's not something you want to extrapolate. Fundamental performance, you can argue maybe there's something better in the US, maybe there's not, but just price multiple moves.
Yeah.
So I think the number one thing is to cheat your question and go, you've lived through a tremendous period of richening, particularly for a US investor. I'm not saying dump them, but I'm saying to assume that's going to happen again is a little crazy, and doing some other things, be they the things we like or whatever you think can add value that's not just a straight bet on equities rising, is always important. You always want to build the best portfolio you can, is more important now than it normally is.
Yeah, this is what Aswath Damjaran was talking about with Haslinda, and the fact that we're in a pricing market right now. It's about momentum and vibes more than fundamentals. I want to ask about, we have a really cool function on the Bloomberg, ECAN Go, ECAN Go, and you can, we have AI now powering a search through companies' earnings reports, and I ran a search here to see how often people mention machine learning and AI itself. And obviously, it's blown up in 2023. And whenever I started thinking about this at first, I thought a lot about you and AQR, because
how often do you think about me?
Well, with Sonali next to
sorry.
me. No, I mean, I love to think about quants and how they can put this kind of thing to use. And I remember a couple years ago reading a story about how you were hiring all of these, computer science guys from University of Chicago. And how much can you put AI to use and gain an edge over other people who are, I hope, doing the same thing?
Sure. Well, that's a separate question, and I do think, I'll skip to the end on that.
Yeah.
I do think the AI world will be far more dynamic than what you might call the quant factor investing world. You do a very good version of what Warren Buffett's doing. You'll have bad times, but if you stick with it, I think the whole world can know about it, and you can still make money from it.
Well, we don't have to throw away the Benjamin Graham book now?
No. AI, big data, alternative data sets will be, I think, a more constant arms race where you have to keep reinventing what you do. I'm actually optimistic we can do that, but it will have more of that element. AI is a really complex topic to even discuss about how a firm like ours is using it. If you guys want to give me a 3-hour segment and kill your ratings forever.
You have 3 minutes left.
I know, it's hard to do AI in 3 minutes. But at our firm, we're using it in at least 3 different ways. One is signal generation. Literally, quant signals we've always done that could be done better. The classic example is using natural language processing to look at written and verbal information and turn that into, is this good news or bad news? Quants have done this forever. They've done it with word counts. You see the word increasing, you do a +1. That was very coarse. If the actual sentence was massive embezzlement is increasing, then +1 was probably not your best call. Quants only have to be right about 53% of the time, so that's okay. Turns out NLP, machine learning, is just better than our old methods at doing that. A second way we're using AI is how to combine our factors, how to weight them. This is a little annoying because the old joke, or recession is when your neighbor loses your job, or depression is when you lose your job. AI's coming for me now because I've always been one of the AQR who makes kind of the final call on weights, on how much, I don't do this every day, we're not traders, but what should be the final weights are not all model driven because you can overfit that way. AI is taking over some of that role. Turns out it's annoyingly better than me. So that's another way. Finally, just as a productivity tool, which is the most mundane, but just to code, AI is making everything faster and probably moving what you talked about, that innovation cycle itself. AI for AI, to use AI is there. The other really kind of cool way to think about AI, and I probably slowed our firm down by a year or two on this. I think sometimes the old man's job at the firm is to slow things down when there's new stuff. But forever we've talked about not overfitting. That a danger of quantitative processes is you see things in the data that were random. You think you can trade them, but they weren't real. AI, and the way you combat that, by the way, is to combine data with theory and common sense. AI, to be honest, pushes us a little on the spectrum away from some of the traditional things we've talked about. And that was uncomfortable for me. You are surrendering yourself a little bit more to the machine. If there's limited data, you still need some economic priors. If there's a lot of data, you sometimes don't. One of my partners, Brian Kelly, has written a paper with a title I love called The Virtue of Complexity, because everyone always talks about the virtue of simplicity. Even I've had to adjust to a world where maybe simplicity isn't always the goal. Complexity can be the goal.
Over and over and over, we have one Wall Street executive after another saying AI is not going to take your job. But you've come here and said AI is even coming for me in some respects. What does that mean about a job on Wall Street over the next 5, 10, 20 years?
That's the operative question, is over what time horizon. Not to get philosophical, but on a significantly long enough time horizon, it's coming after all our jobs, right? Which is not necessarily a bad thing depending on the transition. We get to a world of Star Trek where we have a replicator that can make whatever we want. That's not necessarily terrible news, but it could be a lot of upheaval on the way to that. I think clearly, so far at AQR, it is certainly, we've not shrunk because of AI. It has made our existing people more productive. Forecasting 5 or 10 years down the road is, of course, a lot harder, and I'm not sure a quant geek who lives for diversification is the guy you want doing this. But increasingly, you have a job like doing an RFP. A client wants questions answered.
Right.
That's going to get much more AI over time. I doubt even on a 10-year horizon we'll get to a point where no human has to look at it. Right now, we are not at that point. I would not release something that was pure ChatGPT to a client. But it's all about time horizon. All this is coming. And I'm not the guy to do it, but how society adjusts to it, that's the question. You cannot stop technology. And I always laugh when I hear about people like, we're going to stop automation. I'm like, yeah, good luck with that. Yeah. You can slow it down a little bit and maybe let some other country beat us at it. But it's coming for all our jobs. My wife went on a quest for our 4 children who are all in their early 20s.
Right.
At one point saying, what jobs should they pursue that are most safe from AI? And she concluded at the end, yeah, just do what you're interested in. I can't figure it out.
She didn't
and
say
she's
journalist?
Pretty smart.
Yeah. So, Cliff, we have less than 2 minutes left with you. I want to talk about market mechanics here, and I want to talk about leveraged single stock ETFs. I was speaking with your new friend, Mike Green from Simplify on Friday, and we were talking about these leveraged MicroStrategy ETFs. His belief is that that's helping to fuel this record premium that MicroStrategy has to Bitcoin itself. Not specifically about that product, but you think about the proliferation of these types of products. What do you think that means for the market structure and the motion of markets?
all right, I'm drifting from quant now. Whenever I give like broad opinions about market psychology, you should weigh my opinion somewhat less than when I'm talking about AI or diversification, because I'm a little out of my wheelhouse. But I do think if you look at valuation differences, we're still at a time of extremes. And that's not just the Mag 7. You could do it within any industry you want and add them up. I wouldn't call it a bubble. 4 years ago, I would have called it a bubble, but we still are in a time of extremes. I think animal spirits are high.
I keep hearing that.
I don't know how to judge this exactly, but it's partly quantitative, looking at just the spread between what we think are reasonable and unreasonable price stocks. And part of it is qualitative, the part you shouldn't trust me on. But the part you shouldn't trust me on looks at the rise of, say, aggressively levered ETFs and says, yeah, nobody needs those. And then you combine it with 24/7 trading. If you're waking up at 2 a.m. and you need a levered bet on
I often do.
Then you might want to reconsider not just your financial plans, but many things in your life. Extremely levered ETFs, if you hold them long enough, are almost, and I only say almost for legal reasons, are almost certainly going to lose their money. Their volatility drag is very large. If you rebalance them religiously, it depends on the costs that are embedded in them. If you use them for very short-term tactical views, they can make some sense. And then I ask, why do you have very short-term tactical views? Because very few of us, certainly including me, certainly in concentrated non-quant, not Jane Street, but 2 stocks, I don't think these people have any information on it. So I do think it is a speculative tool, a symptom of some things that are still pretty extreme in markets. And well, this is clearly not investment advice, but I wouldn't use them.
Hey, and speaking of speculation,
by the way, that was investment advice.
Speaking of speculation outside of your wheelhouse, my bosses want me to ask this question. I'm like, he's a quant, but how are you investing in Asia with the backdrop of Trump tariffs?
Your bosses are asking me a stupid question. I would never insult you guys, but I'm very comfortable. No, I'm kidding. We're investing like quants. We are relatively, actually really close to balanced by country and industry around the world. That doesn't make us riskless. We have bad periods when the styles we like, reasonable companies at good prices that are starting to turn around, are not being favored. Not going to be a fun time for us. But we have been very good over time at avoiding the big thematic themes. Like tariffs are a lot about specific countries and specific industries. That's where they can play havoc. They can make real winners and losers.
But can you use Trump 1.0 as a blueprint for Trump 2.0?
There are a lot of jokes that write themselves here. I think we're at a time, it could work out very well. I'm not necessarily a pessimist, but I think we are at a time of elevated uncertainty. We can measure that. That's not just an opinion. You can look at dispersion and forecasts of earnings, of economic forecasts. You can look at how bad they're missing when the numbers come out, up or down. Dispersion is just about the size of the miss. It's elevated, and as a soft sense, whether you love it or hate it, the Trump world is going to be very different than the prior world. So I do think economic uncertainty is larger. I'll give a blatant commercial. I think things like trend-following strategies that are what are called positively convex, it's the geek term for they tend to do well in tumult, are probably a better time. But mostly when it comes to picking individual stocks, we run away from your question. So it wasn't a stupid question. It was just not the right question for a quant.
Well, another Trump question for you. We do have less than a minute left here. But do you think that the tax cuts, if achieved, will be fuel for the market, as certain investors believe?
They usually are in the short term. We do have, you don't need me here to tell you, we have a bit of a deficit problem that it doesn't appear that either party wants to take. We could talk about government getting more efficient. We could talk about Doge. Do they still pronounce it Doge?
I think it's
Department?
Doge.
Still Doge, even when it's the Department of Government Efficiency?
I think so, unless it's doggy.
I'm copying this from Twitter. Someone else said it, but it cracks me up that we have 2 guys heading the Department of Government Efficiency.
Yes.
It's like, first thing, fire 1 guy. That's what either of them would do. And I'm not saying which one. I'm not going there. I do think we are in a world of more uncertainty. I think when it comes to stimulative things, the budget deficits are going to matter at some point. Many of us would have thought they'd matter 20 years ago and have been dead wrong. So I'm not going to do the sucker's game of trying to time when that matters. But at what point we consider something stimulative versus, oh my God, we've gone too far, is something I would be terrified to trade on. So I'm not trading on that. But that point does exist. So I won't make any firm forecasts. I just think we're in for an interesting ride in one direction or another coming up.
Cliff, we thank you so much for joining us here in studio. Of course, that is Cliff Asness of AQR Capital on the markets, on AI. They're coming for our jobs.
Sorry.
I heard.
I hope. I'm going to be so happy when I'm sitting in that chair that moves around the spaceship with my giant icy.
As long as there's universal basic income or something.
Yeah.
We
Well,
need,
it actually has to come with that.
Yeah.
A world of superabundance means people have to be able to participate in that abundance.
All right, so there's some preconditions there. Cliff, you have to come back soon.
Oh, this is fun.
Enjoy this. We're going to
Thank you.
switch gears pretty dramatically here because there's one stock we're watching, and it's Lifeway Foods. It's fighting off a hostile takeover, and the U.S. kefir supplier has rejected 2 takeover bids from Danone so far, who already holds a 23.3% stake in the company. Now, Lifeway says that they are not opposed to a sale if they got an offer at the right value. Joining us now with more, I am thrilled to say we're joined now by Julie Smolyansky. She is the CEO of Lifeway Foods. Julie, it's great to have you with us. The latest is that you rejected Danone's increased $27 per share offer. That came in late November, and the board said at the time that the revised proposal substantially undervalues Lifeway. And I know you can't get too specific here, but what does substantial mean?
I'll leave that to the board and to the advisors. But what I can tell you is that Lifeway was started by my father, founded by Michael Smolyansky, with an ancient recipe passed down generation to generation from my grandparents, my ancestors for over 2,000 years. And what I can also tell you is that science is now catching up. And I would say we're really at a tipping point in the entire food industry, but especially in the probiotic industry. We're just learning about the microbiome, its impact on the gut, mental health, immunity, skin health. We're seeing an epidemic of foodborne illnesses, salmonella and listeria outbreaks. We know that Lifeway kefir can help prevent some of the impact of gastrointestinal issues, impacted from foodborne illnesses. We know that there's effects of GLP-1. I know everyone's interested in that topic right now. The consumption of calcium, protein, and probiotics can have natural occurring GLP-1 effects, but also a really important high protein bioavailable food that those who are on that drug should be consuming on a daily basis. We've had 20 quarters of consistent growth, so I'm not surprised that there are eyes on us. The last 5 quarters alone have been record historic quarters. We've doubled our business in the last 5 years. Our gross profit has increased almost 100%. Our share price, while I don't really look at our share price, but it does reflect all the hard work of,
Julie, I'm looking at your share price over the last 5 years, and I compare it to Danone, which over the last 5 years, Danone is down 11%. You're up 1,201%. So
that's right.
I mean, it's off to the races for Lifeway, but you mentioned all the benefits of probiotics and kefir. I think a lot of people are talking about this. So you're going to have a lot of competition in the next couple of years. And Danone is a pretty big company with which to compete, even if their stock has done nothing in 5 years. How are you going to take on that competition without a big financial backer?
Well, we welcome all competition, and Lifeway has been around for 38 years competing with giant behemoth multinational companies. We're the #1 drinkable in the world, in the country, definitely, but we're the global global category leader. We have a 95% market share in the United States alone, which dominates at least 20% of the entire probiotic global probiotic market.
But it's a small sliver, Julie, because your company is worth less than $500 million, and Danone is worth $44 billion euros. I mean, behemoth is the right word. So if you want to go up against them, you need serious firepower. Have you got any other partners in mind?
Well, I think you need real authenticity and a recipe like Lifeway's that's passed down generation to generation. We've competed with giant companies in their own backyard. In Europe, our products are now distributed in Mexico. We're the #1 product in Mexico, the #1 kefir in Mexico. We're now in South Africa. We just signed a distribution deal in UAE and Dubai. We're distributed in Europe, where we did compete with large multinational companies and took over their market share and even forced them to discontinue some of their products. There's a lot of brands in the food space. There's competition everywhere, and I think a rising tide raises all ships. So it would be great if there was competition and, bringing attention to the category. And I think when people compare the various options, they'll see that the Lifeway recipes, from our kefir drinks to our Pro Bugs for children's, which you're showing right now, to our farmer's cheese, which is a legacy product. I think that when you compare the quality and you learn about the authenticity of the brand, and all the great things that we do, I think that you'll fall in love with Lifeway like so many consumers around the world have for the last 38 years.
What's the fear, I guess? What would it mean to be owned by a bigger company or partner with a bigger company? I mean, is there something that you could do alone that you couldn't do with them?
I can't speculate on that, but what I can tell you is that Lifeway's a brand on the move, and we haven't even scratched the surface on all of our opportunities. The world is really just starting to catch up to what we've always known, what my ancestors have known, which is that kefir is necessary for the gut, and that your life is significantly improved from mental health to skin health to immunity and digestion. So, that's what's really important. That's what our team is focused on. And I know that we're nimble and fast, and we can respond to the marketplace like we have for 38 years. Like, we just launched 10 new, exciting, brand new, trendy flavors, like taro ube, matcha latte, lychee, and these are all lactose free. And so I think, the fact that, so many companies are trying to imitate what Lifeway is doing, it tells me that we're just at the tipping point of all of the opportunities available for Lifeway.
Well, lactose-free is definitely huge for people who might shy away from all that dairy. But like you said, a lot to keep an eye on here. So please keep in touch. That, of course, is Julie Smolyansky, the CEO of Lifeway. Meanwhile, let's get a check on these markets. Over an hour into the U.S. trading session, we'll do that with Abigail Doolittle.
The major averages right now, Katie, are making very small moves. At S&P 500 up slightly. So let's take a look at a couple of the averages that are outperforming and underperforming. The Golden Dragon China Index up 1.1%. This, of course, is China has ratcheted up the trade tensions between the U.S. and China by exporting bans on certain hard materials and metals. On the other hand, the Dow Jones Transportation Average down 1.6%, the worst day since September 4th. 17 out of 20 members are lower, so it's broad-based selling there. We also have some serious selling for the Korean won at the lows, down more than 2%, the worst day at that point since March of 2020. Right now, still, the dollar is gaining against the won by the better part of 2%. In fact, some of the South Korean ETFs are lower, and all of this having to do with the South Korean president announcing martial law as he accuses the opposition of trying to paralyze the administration. We can take a look at those ETFs. They're down pretty good chunks here. And then, of course, we have the S&P 500 relative to short positioning. Citigroup was out today saying that Wall Street, that their short positioning may suggest that the rally is going to keep going. That has to do with money managers. On the other hand, this is the CFTC speculative positioning around the S&P 500 E-mini futures. And you can see when the trend to the upside, when folks got long back into 2021, 2022, it broke down. This chart, in fact, may suggest to the opposite, that the S&P 500 may have some tougher hauling in 2025.
All right, Abigail Doolittle looking at some technicals for us. Coming up, Jaguar, the storied car maker, has a radical rebrand, complete with a guy in a dress swinging a sledgehammer.
I don't see any cars in that.
There are no cars in this commercial, but they have now shown a concept vehicle, the Type 00. We're going to talk to the managing director about the future of Jaguar. That's something that you don't want to miss. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And over the past 2 years, the price of homeowners insurance has surged nationwide. David Weston spoke with the R Street Institute's Jerry Theodoro about the factors driving up rates.
Yeah, so insurance company looks retrospectively. They look at past losses. So they have actuaries that are called pricing actuaries. They look at the amount of the losses in the past, and they try to project them into the future, and they have an expected loss. So the premium covers the expected loss plus the expenses of the insurance company plus a margin for profits. And so this is the basis of rate making. The amount of the risk is associated with the rate that's promulgated.
What does climate change do to actuarial tables?
As I mentioned the word retrospective. One of the problems with the actuarial tools for rating the risks is that they're not leading indicators, they're lagging indicators. So they look at the past. It's like driving by looking in the rearview mirror. You don't know what's going to come out in front of you. So they don't have the data to put in a load for climate change. So they play catch up when the losses exceed what they expected to pay by raising the rates. Climate change has exacerbated the severity of catastrophes. We've done studies and we've talked to 18 scientists. I'm not a meteorologist, but we consulted with the smart guys out there who look at the data. They know the science, they know climate, they know weather, they know catastrophes. And they concluded that the severity has increased, but not necessarily the frequency. And the larger reason for severity increasing is because there's more built up value. Florida had a population of 2.2 million in 1946, and it's now 22 million. It increased 10 times. So there's a lot more built-in value in Florida that's available there to be hit by a hurricane and be destroyed. So climate change has exacerbated the severity because you have got warmer waters, and when it's warm, the moisture goes into the clouds and it comes down as rain. So because we know for a fact that the temperature of the waters, the temperature of the air has increased and the holding capacity of the atmosphere is greater, it's going to dump more down when it does rain. And we've had these torrential downpours. If you've ever been in one of those, it's like needles that are hitting you. You know, we've had them in New York recently and in Vermont and even in Texas, these unexpected places where we had rain catastrophes following droughts. So climate change does contribute, but it's not the only factor that's driving up the rates. It's one of the factors. The biggest one is inflation. Now, inflation, you have higher prices for the kinds of goods, the stuff that you buy at a Home Depot, lumber and metal for sheetrock, and this is more expensive because of supply chain interruptions. So whereas the CPI is about 3%, the cost of goods to repair homes that are needed for homeowners insurance claims have gone up by about 20%. And they'll go up even higher if we have these big tariffs that are introduced, because those will be inflationary.
And that was Jerry Theodoro speaking with David Weston. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, we do have some breaking news, and that is that South Korea is to provide unlimited liquidity if needed two markets. Of course, this follows a few hours after South Korean President Yoon declared martial law in the country. Now, this step being implemented that South Korea is to provide unlimited liquidity to markets if needed. We also have some of their financial chiefs discussing markets at this moment. We will continue to follow the story and bring you any updates we have.
All right, now, Jaguar is going bold in some sense. The automaker unveiled a new concept car today at the Miami Art Week, which features a hot pink design. At least one of them does. That follows a radical rebranding and an ad campaign that sparked a heck of a lot of backlash on social media. In fact, probably the most I've ever seen. The company has stopped selling new vehicles in the UK and will not resume sales until 2026, when it will only offer all-electric vehicles. This from a company that's famous for its V12s and supercharged 5 liters. Joining us now from Miami is Jaguar Managing Director Rawdon Glover. Rawdon, great to have you on the program today. I got to say, I've been thinking about this a lot ever since seeing that commercial, which is like a post-apocalyptic, androgynous kind of, some have called it a woke sort of corporate virtue signaling thing. And the first question I have is just why? Why these images?
Okay, so good question. Jaguar needs to be bold and Jaguar needs to be disruptive. The purpose of this, it was really a tease film. It's not even a TV commercial. It's not been aired anywhere. We've not put a single marketing dollar behind this. But the purpose of this was to indicate that Jaguar is changing, and that Jaguar is changing in a very bold and dramatic way. And it was really designed to get eyeballs on really what we've been doing here in Miami. So a big night for us last night, as you say. We were able to unveil to the world what the future design language, what all future Jaguars are going to look like. And yeah, we've been really, really pleased by the response that we've got.
I feel like the response has been almost universally negative, and at a level that I've never seen before. I mean, we're talking 50, 60,000 comments last time I checked last week, all kind of eviscerating the ad campaign. And I just wonder where you're seeing the positivity, unless it's like a P.T. Barnum thing where it's like all publicity is good publicity.
No, I think the important thing in terms of the tease campaign was to get eyeballs on Jaguar, was to get people interested in what we're doing. I think the positivity that certainly I'm taking is the response that we've had to the design of the vehicle, which is really, and the future direction of all future Jaguars. That's the most important thing in this context.
And let's talk a little bit about the concept car that actually was revealed. Of course, a lot of attention paid to the advertising campaign. But you came out, you unveiled the new concept car yesterday, I believe it was. So this is a concept car. How different will the final product be once it's actually on the road?
Okay. So you're absolutely right. This is, if you like, the design vision, but this is a very, very clear signpost for all future Jaguars that are going to come off this platform. And what I'd want your viewers to take out of it is look at those bold proportions, look at the incredible silhouette of that vehicle, look at the drama and the presence that that vehicle has. Our first production vehicle, which, as you said earlier, will be with US clients the end of 26, that's going to be a 4-door GT. And actually, I'm really confident that when people see that vehicle, they will absolutely see the link between the concept car type 00 that we're showing here today. There's a very, very clear lineage between that car and what we see here today. And that car, we think, is going to be transformational for Jaguar as a brand. It's going to have incredible range, incredible performance, 430 miles of range, super fast charging speed, 200 miles in 15 minutes. Most importantly, particularly for our Jaguar fans, it's going to drive like the very, very best Jaguars. So we're really, really excited about this proposition, and we think the US clients are going to love it.
One question I have about the design is, why does this indicate to you the future of luxury? You know, what about this car is screaming that you should be paying more for it than you had from the even the previous Jaguar models, right? I mean, it was already seen as a premium brand, but clearly this is a market with a lot of competition. What I don't understand is the change in taste.
Okay. So Jaguar has a clear strategy to reposition the brand into higher price points. If you're going to do that, it's really important that your product actually delivers in that context. We've researched this vehicle in North America, in China, in the UK, and Europe, and we absolutely have had a resounding response to the proportions, the scale, the dramatic design of the vehicle that absolutely supports that elevation to higher price points. So, and what you see here, I guess, is our interpretation of what we think a Jaguar of the 21st century should look like. It's absolutely in keeping with the spirit of a Jaguar. For those fans that are out there are thinking, okay, maybe it looks very different, but think about what we're doing here. It's very bold, it's very innovative, but that's absolutely been in Jaguar's DNA throughout its history. Think for a moment about what the world would have been like when we landed the E-Type in 1961 in Geneva. Nobody had seen anything like that. The proportions, the beauty of it. And actually, we're trying to replicate the same sort of thing. We did the same with the XJS. We've done it right throughout our history. And really, that's what this signals for the Jaguar brand. It's us returning to what we think is the natural habitat for this brand.
But all electric.
All electric, yeah, and that's our future. But again, it's important we think about the context of timing. So the first vehicles will be with clients end of 2026, but this is about a long-term play for Jaguar.
Right.
You know, a platform which this is on, this is a dedicated platform for these designs, dedicated to us, designed, engineered, built in the UK. But this is for like an 8-9 year period. So let's not confine our thinking just to what's happening in 2024. No. Because this will go right into the next decade.
All right, I have a lot more questions, Rawdon. Unfortunately, we don't have time, so I hope we can get you back because it is fascinating to say the least. Rawdon Glover there, Managing Director at Jaguar. Tomorrow we're going to talk to the CEO of Lamborghini. They still make a stonking V12. This is Bloomberg.